Meta shares are up approximately 26% on the release of their earnings, and there's a lot of good news in the earnings release. However, there are some things that you got to be aware of that could potentially be a risk, and so I'm going to break all of that down in this video. So guys, as you smash that like button, let me run the intro. What's up guys, and welcome back to the channel. So it's very interesting. Meta released pretty positive results, and I think the best part about it is that they provided us with a much better outlook, because one of the major things that a lot of us were worrying about as it came to sort of modeling this company out into the future was the fact that the company was just going to be less profitable. And so, you know, Mark Zuckerberg really did a good job, in my opinion at least. He took that feedback head on, and he effectively said that 2023 is going to be the year of efficiency with the company, and he's going to try and help bring it back to its previous level of profitability. Obviously, it's not going to get back to the insane levels of profitability that it was before. However, they're moving in the right direction, and so let's dive into this. So you can see today that the shares were up 26% on the release of the earnings, which was absolutely phenomenal. You know, they were down a little bit after hours, but you know, ultimately it's trading at $185 per share. And if you could recall, I had previously valued the company at around $175 per share, I think around 175, 180, somewhere around there. So it's interesting that it came up. However, my valuation actually changed as a result of the information that they put out in this release. And you can see that it's not just my valuation that kind of changed. Look at how the market really came back. You know, I think when I released the video, the shares were around $110 per share, and like now we're at, you know, $190 per share. Now I got to come clean with you guys. Although I did identify that Meta was cheap, I didn't actually end up buying it. Not that I told you guys I was going to buy it anyways. I was really focusing on portfolio optimization. And so, you know, this is one of those opportunities where it ran up 50%. And I don't want to pretend like another YouTuber might, where they say, oh, you know, I identified it, I'm genius. Actually, this is one of those situations where I saw the opportunity, but I didn't dive into it, which is totally fine in certain cases. And I think one of the biggest items that caused the shares to surge as much as they did is because, you know, when Snap released their earnings, Snap actually suggested that revenue could decline unofficially, at least. And, you know, what we got from Meta was actually positive guidance compared to Snap. But the other thing is we got a lot of positive guidance in terms of profitability. And so I think that really helps Meta's story, comparing it and contrasting it to Snap's story. And here are the main takeaways that were in the article that I just showed you guys. You know, the company does expect its total expenses to decline in the range of 89 to 95 billion from their previous outlook of 94 to 100 billion. And so that was a big deal. And there's other items which I'll dive into a little bit more. The one item that a lot of people were focusing on, especially people like myself who value the company using free cash flow, is that they're lowering their capital expenditure estimates for the year in 2023 to around 30 to 33 billion, down from 34 to 37 billion. And of course, you know, a lot of people are happy that they authorized a $40 billion increase to their stock repurchase plan, but you shouldn't ever really get excited about that, because at the end of the day, they're gonna continue to repurchase shares because they have so much excess capital. The company, I think right now, if I'm not mistaken, has around $13 per share of excess capital. And so they're just going to continue to reauthorize that stuff. So I wouldn't get too excited about that, nor should it impact your valuation at all how they deploy capital. And of course, I have to caveat that, because if they're deploying capital in inefficient sort of investments, obviously that would impact their valuation. And so let's just dive into the results a little bit. So, you know, their monthly active people using their apps has increased to 3.74 billion people, which is kind of crazy. It's very impressive. So, you know, almost most of the people, I guess most of the people in the world use one of their family of apps at least once a month, which is kind of crazy. Now, here's where I want to draw your attention, guys. Notice that ad impressions delivered across their family of apps increased by 23% year over year, but the average price per ad decreased by 22%. And so this is actually concerning, and you got to be careful of this, because what this will do is it will actually increase your COGS, and I'll show you that later. And so, you know, pay attention to what higher impressions and lower monetization does to the overall profitability of the business. This is why, and I'll show you what Mark Zuckerberg started discussing when he started the call. This is why the first thing he focused on is talking about profitability. So the minute I read this, this is something that I did call out last quarter as well. So once again, you know, I don't want to see this trend going forward. You want to see pricing increase along with impressions increasing. So you don't want the fact that impressions are increasing to make up for the fact that you have an underlying problem in the business, which is pricing is declining. So keep that in mind, because it's not a rosy the stock is going to double from here story, especially when they're still concerned about profitability per impression. And so I want to dive into that COGS issue a little bit more. So notice how COGS are actually up 7 turns from last year. That is fundamentally what you're seeing with the more impressions and lower price or lower revenue per impression. So, that's what's causing that to jump. So the question I have for you guys, and let me know in the comments what you think, how should you forecast this number out? Are you going to forecast cost as a percentage of revenue to be at around 26%? Are you going to forecast it at 24%? Or are you going to forecast it around 22%? Because depending on how you forecast this out will mean the difference between a valuation of $100 per share or a valuation of $250 per share. So this is a big deal. And this is what a lot of people were worried about. And, I brought it up a little bit. I took up my cost expectations in the last model, which is why I was slightly under where everyone else was falling. I was at around $175 per share, where everyone is falling at around $225 to $250. But, I'm glad that they're starting to address this. And so let's get into how they're starting to address it. So the first place where I would have looked to see them addressing it would be their CFO. But notice that she doesn't really talk about the cost to sustain higher impressions to bring in the same revenue. Here's what she mentioned. She said cost of revenue increased 31%, driven mostly by a write-down of certain data center assets as well as growth in infrastructure-related costs. Okay, that's fine. But what I ended up finding as I was going through the transcript is that this was such an important issue that Mark Zuckerberg actually focused more on it. And so in other words, he took the story away from the CFO, which is not normally what you would see for a COGS discussion, but it is what it is. And so you can see him starting off by saying that I want to discuss my management theme of 2023, which is the year of efficiency. So that's how focused he is on profitability for 2023. And this is why I think the market is reacting the way that they are. And so he said that we've taken some additional steps, like working with our infrastructure team on how to deliver our roadmap while spending less on CapEx. The other thing that they're doing is they're flattening their organizational structure and removing some layers of middle management to make decisions faster, as well as deploying AI tools to help our engineers be more productive. So in other words, more layoffs are potentially coming. And when you're saying you're deploying AI tools to help your engineers be more productive, are you saying you're using ChatGPT to write code? Because that's kind of the read through that I'm getting there. And then he finished off by, focusing his attention on delivering better financial results than what they've recently reported, and on meeting the expectations that he outlined last year, which was delivering compounding earnings growth even while investing aggressively in future technology. So effectively what he's saying is, he's reiterating the concerns that we all had where they were investing in spite of profitability. Well, now he's sort of like tapering that back a little bit, and they're just going to say, look, we're going to continue to invest. However, we're also going to focus on profitability at the same time. So this is what everybody wanted to hear anyways. And so, it really is sort of like a shift in our interpretation of how they're thinking about the business overall. So of course, you can imagine that a lot of people's valuations would have been taken up just by their top guy, Mark Zuckerberg, their CEO, speaking exclusively about profitability in his first comment on the quarterly results. So I really like that. I like how he's focusing on it. And I like that the message is coming from the CEO, not CFO, in this situation, because it's such a big issue to the way that the investment community was looking at the company's results overall. And now let's just dive into some of the priorities. Now, these haven't actually changed from last quarter. So if you watch that video last quarter, it's going to be the same. So, they're focusing on artificial intelligence and the metaverse. And when he talks about artificial intelligence, he's basically using AI tools to increase impressions for people. So in other words, they're using AI tools to get people more engaged in their apps. So, they're using AI tools to feed better reels to people. I'm already seeing it happen. As a new parent, I'm starting to see more and more sort of like parent related reels that are coming to me. So, they're very good at this. And, I think they're just doing it based on what reels I'm watching and for how long. So basically similar to how YouTube does it. And so you're seeing this work, and I have have found that I've been spending more time going through reels, especially, you know, as I'm like just doing nothing, like waiting for like something to finish cooking or something along those lines. Like I'll just start scrolling, and you know, it is working. And so if it's working on me, I know that it's working on pretty much the population. And that's kind of what he's saying as well, right? The reels is really picking up. So the next step is profitability, and that's exactly what he gets into here. So obviously they're winning on getting people to use it. Now it's how do you monetize it? And so this is their next bottleneck, and this is what they've been talking about even in the last quarter. They're focused on continuing to grow reels and improve its monetization efficiency. Notice how they're using the word efficiency. This is because they've been inefficient in generating revenue as a percentage of the impressions that they've been generating. And so that's exactly what they're doing, and they're using a new metric that they're going to focus on, which is revenue per minute of reels watched. So watch out for this. They're probably going to be using this metric more and more as time goes on. And so, you know, the more reel grows, even though it adds engagement to the system overall, it takes some time away from feed, and we actually lose money. So that's the challenge that they have. But because people want to see more reels, they gotta unlock and improve the monetization efficiencies in the product. And so that's what they're focusing on. And that is exactly what I'm going to be looking out for in the subsequent quarterly results as time goes on, because this is kind of what we want to see. You got 4 quarters, which are telling you that it's going to take them around 4 quarters to reach parity. And so let's see if that actually happens with their other products. Now, moving on, I don't think Meta really does a good job with this slide. This is kind of how I would present it if I was presenting it to like senior management. In fact, I'd probably just present it in a completely different way. But notice that, you know, year over year, every single geography picked up in 2021, and then in 2022, just for the quarter at least, notice that the rest of the world market actually is up year over year. So that's, you know, a small like light for the results overall. You know, like it's a good thing in my perspective. The other thing is, notice Asia Pacific wasn't actually down as much as you think that they were. I thought that they would be hit a little bit more. Obviously, Europe is really challenged at the moment, and I don't expect the comps for Europe to improve in the first quarter. So I think you're probably going to see double-digit declines in Europe as well. But here's the best part. The fact that in spite of the declining ad spend market, they still maintained revenue somewhat. Now, of course, you guys know how they did it. They just increased impressions, but their pricing is down. But notice how they just were able to maintain it. And so I really like this. So I think the 2 beacons of light are the US and Canada environment, and of course the rest of the world and Asia Pac. So the only real challenge geographically is Europe. Now, I don't think those European challenges are perpetual. I think they'll get through it. And so overall, you know, what you're seeing here is a good story. And so, you know, overall you're down 4.5% quarter over quarter, but I just don't think any of these issues, you know, the main issue being Europe, is a secular trend. I don't think Europe is declining into perpetuity. Yeah, you might have another challenging year in 2023 and maybe some lingering challenges in 2024, but I think they get past it. And so I think this is somewhat of a good news story. I was more concerned about US and Canada falling off than it actually did. And so I'm very happy at that, and I hope that that trend continues. And Mark Zuckerberg goes on to talk more about the monetization opportunity. And so what he's talking about is they're excited about that business messaging monetization opportunity. Now, some of you guys have probably heard about that by now, right? They talked about it in the last quarter. I made a big woo-ha about it, but notice that, you know, one of the ways that they're doing this is click to message ads, which now has a $10 billion run rate, and paid messaging is another piece of that. And so I think, you know, they just started unlocking this, and, you know, could it have $100 billion run rate? Absolutely it could, in the future, of course, right? You know, I'm being optimistic here, but, you know, I think that they've kind of figured out how to monetize that WhatsApp platform. I just like the fact that they can integrate this into a sales platform like a Salesforce or something, which really makes it a great solution for enterprise as well. And so I think this just works, and I think this is going to continue to grow, and a lot of people are not taking this into account when they forecast out revenue growth, which I'll show you how I'm forecasting revenue growth closer to the end of this video. Now, the other thing is, as I was discussing before, I do believe AI is the foundation for their discovery engine in their ads business, and it's working. You're seeing it already work. I myself am spending more time on Instagram on their reels, and so absolutely this will just continue to get better as time goes on. Now, this was not that great before, and so the fact that it's starting to work better is really good. And so if that was a lot to digest, let me just summarize it here, because Mark actually summarized it in the last part of his address. So he said, they're focused on AI, including their discovery engine, ads, business messaging, and increasingly generative AI and future platforms for the metaverse. And so, I think that they're going to knock it out of the park in this whole area. Maybe not so much the metaverse. I'm still waiting to sort of, buy in, but I think AR will probably be better than virtual reality, like VR, right? And so you guys let me know what you think. The other part is, and I think once again, this is the reason why the stock surged, is that they are focusing on efficiency and continuing to streamline the company so they can execute those priorities as well as possible. So grow while maintaining your bottom line. And I think a lot of people are starting to align themselves once again with the direction that Meta is going, and thus you're getting a higher valuation. And moving just quickly on the CFO commentary, because some of these numbers are very relevant to us. Recall, guys, that they reduced their expenses to around 89 to 95 billion on a total basis, which is lowered from their previous outlook of 94 to 100 billion dollars. So that's just going to go right to the bottom line. And then, CapEx once again is being reduced. Now, the other thing that I do want to point out, they just kind of snuck it in here, is that their full tax percentage is now expected to be in the low 20s. So recall, in last year, it was in the high teens. So this is actually going to eat away at some of the savings that they're generating up here. So just keep that in mind as you model this out. Now, the only other thing is with the CapEx, I just want a little bit more color here, because they said that part of the reason, or they said last quarter, part of the reason why their CapEx was increasing is all of the incremental CapEx spend was not on Metaverse. It was on all of their other stuff. And so is this suggesting that their new AI investments into the ad business are not panning out to the level at which they expected? Like, they're working, but they're not working at the level, or are they just, developing this stuff slower than they originally thought? Like, I don't know if this is actually a good news story, because you sort of have to read this in conjunction with what they said about CapEx spending last quarter. So that's something to be aware of. And, as news trickles out, just keep that in mind as it relates to their deployment of capital towards the AI in their business. Now, in 2023, overall, I'm just trying to be more fair as I forecast out revenues, because I find that I'm just a little bit too pessimistic sometimes. Like, I should just be forecasting out the P&L fairly, and then take a large margin of safety on the share price itself, and so relative to the valuation. And so, with respect to growing our revenues, I'm not happy or upset over this revenue forecast, which means that it's probably likely fair. So essentially what I'm saying is that 2023, this might be a little bit optimistic. It might be around 5%. We'll see how the economy sort of falls out, like just growth in GDP as a whole. I think, in the back half of 2023, you might get an increase in spend. Who knows? We'll see. And then I think by 2025, they will have completely matured all of their new investments that they're putting in with the click to messaging and all that stuff, especially also like the AI with the Reels. I think you give them 2 years and then they start growing revenues fast again. Now, how long do they continue growing revenues out? I don't know. I'll probably give them 5 years until I taper that growth expectation down a little bit. But I want to know what you guys think with respect to how you guys are forecasting out revenues. Now, with respect to the costs, notice that their costs were approximately 22% of revenue in 2022. I'm bringing this down to around 20% and then bringing it down again in 2024, because you're going to get some one-time charges and stuff in here as well. And so, this just reflects the efficiency initiatives. With R&D, I'm not really giving them the efficiency in 2023, but in 2024 and beyond, I'm giving them just baking in a little bit of efficiency as we sort of build this company out into the future. With marketing and sales, I'm kind of leaving it the same. And then with G&A, I brought up G&A in 2023 just to get to that total cost figure that they're forecasting out. But I think G&A does decline as time goes on as a percentage of revenue, because you can just do more with less. And so I think that's reasonable. But the other thing I want you to focus on, guys, is that tax rate. Remember, it's 19.5% in 2022. But if you model this out, you would want to model it out with 2 turns higher at 21.5%. So it is going up. They just snuck that in there, but keep that in mind. Now, overall with Meta, I do believe that there is an opportunity that remains in the company. I have hidden the intrinsic value because I want the people on the Patreon to see where I revalued this company first. And you can join us on the Patreon at that $5 a month level, which is pretty cheap relative to what you get. But once you see the intrinsic value, what I really want you to do is click into here and go right into the meta model to see how I built the whole thing up. And so, it closed up 23% to 188.77, but I still think there is some opportunity here. I don't know if I'm going to be participating. I haven't made up my mind yet, but there is still some excitement in the name. Now, because the share price has gone higher, there is more of a risk that it will come back down. And so just keep that in mind. I think the margin of safety has actually dwindled on this name relative to where it was previously. And so I would just keep that in mind as you guys model this out. I want to know what you guys are valuing this at. I think most people are valuing it around $250 per share. I would say that I'm probably around there as well. And so, jump into the model and take a look at exactly what I'm landing at. And if you're new to the channel and you don't know what I'm talking about, you can get access to all of my research and the tracker and everything else at this lower tier. And of course, if you want to join us on a live Zoom call every month, in fact, we have a Zoom call this Saturday, you can join us at that higher tier. Now, here's something very relevant for you guys. A lot of you guys are up, 40, 50% on Meta. So the question is, when should you sell that security? And I actually put together a video which discusses just that problem, and you can get to that video right here.